Good morning and welcome to day 28 of financial accounting. This is the fall 2022 semester. It's Tuesday, December 26th, and we are going to be starting chapter 14 today. So you want to have your chapter 14 exercises open in Cengage. Because we finished chapter 13 last class, the chapter 13 problem should be submitted for grading by the end of the day. And because we're starting chapter 14, then the chapter 14 pre-quiz should also be submitted for grading. And we'll be covering chapter 14 on financial statement analysis today, Thursday. So then the exercises we do on Thursday. Looking ahead then, the problem will be due on Tuesday, which is not an actual class day. It is day 30, but we won't be having on-campus class on that day. We'll be having a review session at our regular class time. That review session will be held on Zoom only. And of course, like every class, I guess it's optional. You are welcome to attend or not attend if you are ready to take the exam and don't feel the need for review. My expectation is at that review session, we'd be covering the practice set for exam 5. And then exam 5 is due on Friday the 16th by the end of the day, along with the final part of your real world annual report project for this semester. Grades are then due on Monday. So everything that you want included in your grade needs to be submitted by Friday. After midnight on Friday, anything that has not been submitted for grading will become a 0 in the grade book. So nothing else will be accepted after Friday night. I had someone ask before class started about when the exam will be available. The exam is, God bless you. The exam is available now. It has been available since the middle of August. And so you are welcome to take the exam whenever you are ready. I would, of course, strongly recommend that you finish all the work through chapter 14 problem before you take the exam, but it is available for you to take whenever you are ready to do that. I know a couple people in one of my other classes wanted to take their exam early because they have 3 other exams next week and they just wanted to space them out. If that works for you, that is fine with me. You can take it whenever you'd like. Just make sure you get any questions answered before you try to take the exam. Okay, any questions, anything you want to talk about before we start chapter 14? So any questions from the cash flow statement chapter, from the stockholders equity chapter? Those are the 2 chapters along with chapter 14 that will be on your last exam. The last exam is not cumulative in the same way that with exams 1 through 4, there's certainly knowledge from the earlier chapters that you need in order to do this chapter appropriately. But there are no specific questions on inventories or receivables, so like that. So on Thursday of this week, we will, once we finish the chapter, we will take a look at the practice set and the exam as we have for all of the other exams that you've taken earlier in this semester. And assuming that we have the review session on Tuesday, which means that someone has to be there. If there's anyone there and we have a review session, I will record it and post the recording just as we have for all of the other exams this semester. All right, well, if you don't have any questions, then let's get started. Just one other comment I was thinking about as I was coming over to morning. So for those of you who will be taking managerial accounting at JCC in the spring semester, regardless of who you have, so if you're taking it on campus, you are not going to have me. We do have a person in place who's going to be covering that class. If you're taking it online with me or taking it on Zoom with another instructor from the Olean campus, regardless of who you have for that class, you do not need to buy anything new. The subscription that you bought for this semester will cover you for managerial accounting as well, regardless of who your instructor is for that class. I think, though, that there is going to be a code that you need to access that. And so again, regardless of who your instructor is, and we're all female, she will be able to provide that code to you, or Cengage will provide it to you. So I just want to get that message out there that please do not repurchase a subscription for the spring semester for managerial accounting. Regardless of who you have, you do not need to buy a new subscription, but you may need a code to be able to access it. Also, I should just throw out there, regardless of who you have for managerial accounting, the course will be structured very much like what you're doing this semester. So the other two people who will be teaching this class are taking my course, or taking my content, and certainly they may tweak it, do something different, but it will be the same format with the 14 chapters. So it's chapters 15 through 28 are covered in that course, and it will be pre-quiz, exercises, problem, and one project rather than 5, and 4 exams rather than 5. So, but it will look very similar to what you are doing this semester. Again, regardless of who you have for the course. All right. So let's get started with our final chapter for this semester. We're almost there. And this chapter, as I mentioned last week, is financial statement analysis. So starting with chapter 4, we started covering, 1 or 2 ratios or calculations each chapter that we might use to analyze a company to make some decisions about how that company is doing. And we know that's really the purpose of accounting, is to help people make decisions about a company, whether they're inside or outside the company. In this chapter, we're really going to be pulling that together. So we'll be seeing a number of calculations, financial statement ratios that we have been using starting in chapter 4, but we'll be introducing some additional ones and talking about really getting the big picture, that comprehensive look at how a company is doing. So we have several learning objectives for this chapter. As you can see, almost all of them involve analyzing financial statement information. So where do we get the information? How do we use it? In learning objective 6, I'm just going to say we're really not going to talk about that, because you've already been doing that throughout the entire semester. You chose a company at the beginning of the semester, and you looked at their annual report to prepare the projects, those mini projects with each exam. You've also looked at several other companies' annual reports. And so you really should be familiar with the contents of what's in a company's annual report, because you've looked at so many at this point, at least to find the information you needed for your mini projects. So objective 6, we will not be covering during class. You still should read what the book has to say about it, because there's probably something in there that you don't know or haven't seen. As always, if you read something in the book, even if it's not something we talk about in class, if you have questions about it, you absolutely should ask about your questions. And so again, we've been saying since chapter 1, which was 14 weeks ago now, the whole point of accounting is to provide information to decision makers. And as decision makers outside the company, in many cases, the only information you have access to is in the corporate financial statements in that annual report, because that's what they are required to share with the public. And so as we're looking at that information in that annual report, the general purpose financial statements that we have been working on throughout this semester are in a required format, so that people trying to make decisions about the company can understand what they're seeing, because it looks basically the same. So the principles, generally accepted accounting principles, or GAAP, that you've been learning starting in chapter 1, lead to a coherent set of financial statements that are comparable across companies and across years within the same company. And so as we're looking at making decisions using financial statements, we've talked about those standards of comparison. I've given you 3 different standards of comparison that we might use. You might be a rule of thumb, such as for the current ratio, the general rule of thumb is anything greater than 1.6, you're probably okay. Anything less than that, we want to look into that a little bit more closely. We might, if we don't have a rule of thumb, or even if we do, we also might want to compare ourselves to ourselves, looking at how did we do compared to last year or compared to the last 5 years. And we also might want to compare ourselves to our competition. So looking at industry standards, industry averages, or benchmarking against one particular competitor who's maybe the leader in our industry, for example. So we've again talked about since chapter 1 that companies have a couple main goals. That is being able to pay their bills when they come due. Liquidity refers to being able to pay their bills. How close are their assets to being cash so that they can pay their bills in the short term? But solvency is more of a long-term question. Are they going to be around in the long term? Are they a viable company? And of course, profitability refers to income statement information. Are they making money? And again, we've talked about why making money and having cash are 2 different things. We talked about that a couple times in chapter 13. Because we use accrual-based accounting, the income statement doesn't speak to liquidity, it speaks to profitability, but it doesn't tell us anything about cash. And so that's why we prepare the cash flow statement so that we can reconcile, here's what our income statement showed for our income, but how did our cash actually change in the period that we're analyzing? So we know what those 3 terms refer to. And so we've looked at several different calculations that are ratios. So comparing one value on a financial statement to another value on the financial statement, such as current ratio being the current assets divided by current liabilities. But we're going to be looking at in our first few exercises today, a different way of analyzing financial statements, something that we haven't used up to this point. And that is not just comparing one number, current assets, for example, to another number, current liabilities, but looking more comprehensively at the financial statements and looking at each element of the financial statements and comparing it to something else. So the analytical methods that are what we're going to be using in the first 2 exercises, vertical and horizontal analysis. And then we'll be looking at ratios, again, some of which we have already calculated or used in earlier chapters when we looked at them maybe one at a time, and others which are going to be new in this chapter. So, 1 second here. So once again, no surprise, I don't have the exercises in the practice set. I don't have them in necessarily the order that things are in this PowerPoint, because it's easier to do them in the order of the PowerPoint rather than jumping around. We're actually going to start with exercise 4. Exercise 4 in the set for chapter 14. So I assume that everyone knows what horizontal means. It means from side to side or left to right rather than up and down. So we'll get to vertical analysis shortly, but horizontal analysis means we're looking from side to side. So if you think about how financial statements are set up, and I'll go ahead and move to that. If you think about how financial statements are set up, if we're moving side to side, we're going from one accounting period to the next, right? So in the example you see on the screen, we're looking at 2 years of data that are side by side. When we talk about horizontal analysis, then we start with a basic financial statement, such as the income statement or the balance sheet. Our example is going to be of an income statement, but the example on the screen right now is a balance sheet. The same principles apply, the same approach to how do we do this analysis. So we know that GAAP requires us to provide what are called comparative financial statements, and I'll put that word on the screen in case you're not, try to spell it correctly. So comparative financial statements. Oh, there it is right at the top of the example anyway. When we say that GAAP requires us to prepare comparative financial statements, that means that we are required at a minimum to report 2 years worth of data side by side. The only time that requirement doesn't apply is if you haven't been around for 2 years. If you're a brand new company, you don't have information from last year to provide. But for the vast majority of companies, virtually all companies, they're not new this year. And so they're required to provide at least 2 years of data. In some of the projects that you've done this semester, you've been asked to indicate how many years of data are on the income statement or are on the balance sheet. And your answer always should have been at least 2. So sometimes they might voluntarily include more than 2. They might include 3 or 4. I've even seen one cash flow statement that had 5 years of data. God bless you. Very rapidly expanding company. And so on their cash flow statement, they had chosen to include 5 years, but typically it's 2 or 3 at the most. And so we already have available to us the comparative financial statement that includes at least 2 years worth of data side by side. To do the horizontal analysis, then we want just 2 years. And we're going to add 2 additional columns, as you can see over here on the right-hand edge of this. 2 additional columns. The first one shows the amount of change from 1 year to the next. If it's an increase, we're going to show it as a positive. If it's a decrease, we show it as a negative, which is why the decrease word here is in parentheses. That's telling you that if it's in parentheses, that means it's negative, and that means it was a decrease from the prior year. The final column then on the right is the percent of change. And to calculate that percent change, we take the dollar amount or the absolute change in dollars, and we divide that by the earlier year. So in this top row, which happens to be current assets, that's typically going to be the first item on a balance sheet. The current assets went up by $17,000. And as a percent of the older year, 17,000 divided by 533,000, that's a 3.2% increase. So it's important to remember as you're calculating that percent change or the relative change that you divide by the older year in your 2 years of data. So you want the change as a percent of the older year in the data. So as we go down the horizontal analysis on the balance sheet, each row is going to include the absolute or the dollar amount of change, and then the relative or the change as a percent of the older year. And you simply do that calculation for each year in your data set. For our exercise, then we're going to be looking at the income statement. And I just want to show you before, oops, if I can change the slide. So this example just gets into a little bit more detail rather than looking at current assets as one lump sum. We did a comparison of each one of the items that makes up our current assets. So we can see the change, our cash went up by almost 40%. Our temporary investments went up by 25%. You can see that a couple others went down. And so this 3.2% that is the total change in current assets matched what we saw on the previous slide, but now we can see the detail. Why did it change? Cash and temporary investments went up dramatically while some others changed, either went down or a much smaller percent change. As I said in our example, we're going to be looking at a comparative income statement. And so you can see here what that would look like, but we're not going to spend any time talking about this because we're going to go to our exercise right now and do our own example. So let's do that. Go to exercise 4 in your, oops, there we go. Exercise 4 in the set for chapter 14 says, income statement data for Winthrop Company for 2 recent years ended December 31st are as follows. So of course, again, the company is required to provide you with these 2 years worth of data. They might include more than that, but we have the 2 years that we need. Just as a reminder, the newer year is almost always listed to the left, and then the older years are pushed out to the right. Excuse me. So we're asked to compare to prepare the comparative income statement with horizontal analysis. So in order to show an increase as a positive, we want to start with the current year and subtract the previous year. So start with the newer year and subtract the older year. If you get a positive value, that tells you that it's an increase. If it's a negative value, make sure you enter it as a negative. I should probably put all my zeros in there. So our sales went up $240,000. As a percent of last year's sales, then divide by 2 million. And then again, make sure you change that into a percent by moving the decimal place 2 places to the right. So that's a 12% increase in our sales. For the expenses that are shown as negatives because they're being subtracted, you do not need to ignore the negatives as you're doing the calculations. So in other words, because our cost of goods sold went up, we want to show that as an increase or as a positive. Please do not show that as a negative. It's an increase in our cost of goods sold. And of course, whatever we put, if we show that the dollar amount or the absolute change is a positive, we also want to show the percentage, the relative change as a positive as well. Any questions about doing these calculations? Okay, I'm going to pause the recording and let you finish up the rest of that comparative income statement on your own, and then restart the recording and we'll do part B together. Okay, so now you should have completed that horizontal analysis of the income statement. And so what do we see? One of the advantages of doing the analysis like this, rather than just looking at the numbers, is it allows us to kind of tease out the differences in those large numbers. Sometimes the numbers are big enough that it makes it hard for us to see exactly what's happening. And looking at it as a percentage or the relative change gives us a little bit more information. So what do we see? We already saw that the sales went up by 12% and that cost of goods sold only went up by 10%. So our sales are increasing faster than the cost of the product that we're selling. And so our gross profit goes up by 26%. Our selling and administrative expenses also went up, and they actually went up faster than our sales did, which is of course not a great thing. Not what we want to have happen. But because of that increase in our gross profit, our income before income tax expense and then our net income went up by a total of 78%. So those numbers at the bottom are still pretty small compared to the numbers at the top of the statement, But a 78% increase in net income is a pretty positive step. So let's go ahead and find our answers to part B. The net income for Winthrop Company increased between years. The increase was the combined result of an increase in sales and a lower, as we already discussed, lower percentage increase in the cost of goods sold. The cost of goods sold increased at a slower rate than the increase in sales, thus causing the percentage increase in gross profit to be greater than the percentage increase in sales. And so again, having those percentages helps us to identify maybe some trends and patterns that are favorable in this case, or unfavorable. So what are we going to focus on when we're looking at where might we improve this? Well, our total operating expenses went up by 20% when our sales only went up by 12%. So that's something maybe we should be focusing on to improve the efficiency or the effectiveness of our business. But we really want to make sure that as our sales go up, or as our cost of goods sold is going up, that we are making up for that with our increase in sales, which might mean selling more product, but it might mean raising our price to account for the increase in the cost of what we're selling. And so that's how we might use the comparative income statement, the horizontal analysis, to analyze a company to see how are they doing. You can see that this might be useful whether you're inside or outside of the company trying to make decisions about that company. Any questions about horizontal analysis? We're going to go back to exercise 1. And talk about vertical analysis. So a horizontal analysis means side by side or side to side, left to right. We're comparing 1 year in the same category. We're comparing 1 year's results to another's. Vertical analysis means up and down. And so we're going to be if you think about what we were just looking at with that comparative financial statement, the income statement or the balance sheet. If we're doing vertical analysis, it means that we're looking at only the results within 1 year at a time. We're looking from top to bottom. And again, we can do vertical analysis of any one of the financial statements. We're going to be looking specifically at the income statement and the balance sheet. And our next exercise is an example of an income statement, vertical analysis. So we're not comparing, at least when we do the calculations, we're not comparing from 1 year to the next. We're only comparing within that one column of numbers, that 1 year of results. So this is a comparative analysis of a balance sheet. And so you can see that the way we do this is we take the largest number on the financial statement. So on the balance sheet, what's the biggest number on the balance sheet? What's the largest dollar amount on a balance sheet? Anyone? What's the largest number on a balance sheet? And I'll give you a hint. It appears in 2 places, but it's the same number. But what is it? Yes, that is but what is that number? Total assets. So thank you. So total assets is the largest number, but it appears twice because we know from the fundamental accounting equation from chapter 1, we know that total assets must also be equal to the total of our liabilities and equity. And so as we're preparing a vertical analysis of a balance sheet, we take that largest number, which is total assets or total liabilities and equity, And we set that at 100%. And then we calculate for each of the numbers that go into that total assets. We calculate, okay, what percentage is that of the total assets? So for example, we start with current assets, and in the most recent year, so the numbers that are in the left-hand column, our current assets are 550,000. And we say, okay, what percentage is that of the total assets? So 550,000 divided by $1,139,500 is 48.3%. The current assets make up 48.3% of our total assets. And we do that for each of the other categories or subcategories within our assets: long-term investments, property, plant, and equipment, intangible assets. We express each of those. You can see the dollar amount and the percent that they make up of our total assets. We can then do that on the other side, what I refer to as the credit side of the balance sheet. And we take each of the categories there under liabilities and under equity and express that as a percent of the total liabilities and equity. And so we're always dividing by that same number, which is the total assets or the total liabilities and equity combined. So we do all the calculations for the first year, and then we look at the second year, the earlier year, and do all of the same calculations based on that year's total assets, that year's total liabilities plus equity. And that is the vertical analysis of a balance sheet. Again, it allows us to see how things might have changed. Once we have all those calculations in place, then we can compare from year to year. So we might say, for example, oh, look, in the earlier year, in 2015, current assets made up only 43.3% of our total assets. But in the later year, 2016, they make up 48.3%. As a percent of the total, our current assets went up by 5%. Now we'd have to do the horizontal analysis to see as a percent of change from year to year, what would that be? I'm not saying that went up by 5%, but as a percent of our total assets, current assets now make up 5% more of that total. Why is that relevant? Well, it affects like our current ratio, the quick ratio or asset test. Working capital might be affected by that. So again, this is an example of a vertical analysis of the balance sheet. You can see that we are able to see both the dollar amounts and the percentages. If we take out those dollar amounts and show only the percentages, that would leave us with what is called a common size financial statement, because you can't see the dollar amounts at all. You see only the percentages. So we'll come back to that. Here's an example of a vertical analysis of an income statement. So we said that on the balance sheet, the largest number is that total assets. On an income statement, the largest number is going to be sales. The top line, the revenues or sales, is going to be the largest number. And so we set that to 100%. And then each of the subsequent lines, each of the lines that comes after that sales, we're going to express as a percent of the sales. And so this is where we're going to start with our second exercise for today, which is exercise 1 in the practice set. We're going to start with a vertical analysis of an income statement. And so I'm not going to go through the description of any of these calculations because we'll see them in our example. Exercise 1 says revenue and expense data for Innovation Quarter Incorporated for 2 recent years are as follows. Prepare an income statement in comparative form, stating each item for both years as a percent of sales. Round your answers to the nearest whole percent. So unlike in the last exercise where we were told to round to 1 decimal place, in this exercise we're told to round to the nearest whole percentage. So we're always going to start with sales as 100%. That's the single largest number. Better be the single largest number on our income statement. And then we're going to express each of the later lines as a percent of that total. And so and again, we're doing vertical analysis. So all of our calculations are combined to just the 1 year. And then we'll go over to the other year and do those calculations. But right now, we're only looking vertically up and down in this 1 year. So 2,280,000 as a percent of the 4 million in sales. It's 57%. It doesn't tell us whether to use negatives or positives, but I am going to use the negative because that helps us, remind us to subtract. Normally within this software, if it doesn't tell you, it will give you credit whether you have the negative or positive there or not. But to be consistent, I'm going to use the negatives to remind us to subtract. Unlike on the balance sheet, we actually can do this addition and subtraction to find the next percentage. So sales minus cost of goods sold is gross margin, or what this book likes to call gross profit. You've heard me say before, I don't really care for that term, but it's what this book uses. So I would prefer you're familiar with the term gross margin rather than gross profit. But gross profit or gross margin is sales minus cost of goods sold. And we could take that $1,720,000 in gross margin and divide by sales to find the percentage, but we can also save ourselves a little bit of time and just subtract. 100 minus 57% leaves us with 43% of our sales as gross profit. That's also known as the gross profit or gross margin ratio. Let's move on to selling expenses. Selling expenses are 600,000 as a percent of the 4 million in sales. That's 15%. Again, I'm going to show that as a negative to remind us to subtract. Administrative expenses, 520,000 out of 4 million or 13%. Show that as a negative to remind us to subtract. Our next line then is going to be the total of those operating expenses. And again, we can just do the math based on what we already have. If selling expenses make up 15% and administrative expenses make up 13% of our sales, that would be a total of 28% of our sales as operating expenses. If we subtract the operating expenses from gross profit, we get operating income, or income before income tax. 1,720 in gross profit minus 1,120 in total operating expenses leaves us with 600,000 in operating income. And again, we can use the numbers we already have. 43% gross profit minus 28% in operating expenses leaves us with 15% for operating income. 240,000 in income tax gives us an income tax rate of 6% of sales. And if the bottom line then would be net income. Again, we can subtract. Oops, should have put a negative there. And we can subtract here 15% of sales as operating income minus 6% of sales as income tax expense leaves us 9% of sales as net income. That's known as our profit margin. Net income divided by sales is profit margin. We have 9% of every dollar in sales. We have 9 cents left after we cover all of our costs and expenses. So all of these calculations are based on just the numbers for that single year. We're expressing each category as a percent of the total sales. Any questions about those calculations? All right, well, I'm going to pause the recording to allow you then to do the calculations for the previous years on your own. And once you finish that part, Restart the recording, please. Okay, so now that we finished that column, and maybe you use the check my work button to check your calculations. But what do we use this for? What can we do with this? What kind of conclusions can we draw from this? Well, without those percentages, if we just looked at the dollar amounts that were given, of course, we'd notice that our sales went up and our cost of goods sold went up and our total operating expenses went up and our net income went down. So we're happy that our sales went up, but we can see once we do the percentages, once we do the vertical analysis, something that isn't necessarily apparent to us until we do those percentages. Yes, we knew that our cost of goods sold went up, but we can now see that went up as a percent of our sales as well. So it's not just that the dollar went up, but the relative amount of cost of goods sold went up. And that's why our gross profit went down by 5%, because our cost of goods sold went up by 5% as a percent of the sales. Total operating expenses actually held the line as a percent of sales. And so that's a good thing. And we're happy that those didn't go up as a percent of our sales. But because of that 5% increase in our cost of goods sold as a percent of sales, it translates directly to a 5% decrease in the bottom line in our profit margin. So that's why our net income went down, even though our sales increased, because our cost was increasing faster than our sales. And that's what we're going to be answering here in part B. The vertical analysis indicates that the cost of goods sold as a percent of sales increased by 5 percentage points, while selling expenses, I didn't point out those I just looked at the total operating expenses, but selling expenses actually decreased by 3 percentage points, while administrative expenses increased by 3%. So that's how it held steady in total. Thus, net income as a percent of sales decreased by 5 percentage points. And so again, having the percentages, the vertical analysis helps us to identify why we had this negative trend happening, why our net income went down even while our sales were increasing. And it allows us to focus our improvements if we're inside the company, or if we're outside the company. It points out that, you know, this company might have an issue with long-term solvency because their profitability has declined. Even though their sales are increasing, their profitability went down, and obviously that's not a good thing. And so hopefully you can see by the use of these, you know, pretty simple tools for vertical analysis, why having the percentages in there, why looking within 1 year is a valuable tool, just like the horizontal analysis is a good way of comparing what happened from year to year. Any questions about the vertical analysis of the income statement in exercise 1? So let me go back to the PowerPoint for a moment. We'll be moving on to exercise 2 here in a second. So I already described to you what a common size statement is. It removes the dollar amounts and we just show the percentages. So it's really a vertical analysis without the dollar amounts included. We're just looking at the percentages. One of the advantages of the common size income statement or balance sheet is it allows us to compare two companies that might be very different size. And so if we think about a local pizzeria, Honest John's right down there on the corner, if Honest John's wants to compare itself to another pizzeria, I don't know what other pizza places there are right around campus here, but maybe there's a Domino's Pizza, or maybe there's a Pizza Hut or some other large chain kind of company. Well, if you're Honest John's and you are just one small local pizzeria and you want to compare yourself to a very large, you know, national chain of pizzerias, you're really going to fall short on every single category if you just compare dollars, right? Domino's Pizza is going to have way more dollars of every category on the assets and every category on the liabilities probably, as well as the equity. So if I'm Honest John's and I want to compare myself to a national chain, I need to take the dollars out of there because in absolute terms, they're going to be bigger than we are in every single category. But using a common size statement where we're just expressing it as a percentage, it might be really useful for us to know as a percent of sales, how does our cost of goods sold compare to theirs? As a percent of sales, how do our operating expenses compare to theirs? So it's useful to compare yourself to another company that might be a very different size, bigger or smaller. It might be useful to compare ourselves to the industry averages. It might also be useful if our company has dramatically changed in size. So if we are comparing ourselves last year to this year, when maybe we had a big acquisition, maybe we expanded and grew substantially, it might be really relevant, really helpful for us to just look at the percentages, even if we're looking at ourselves compared to a previous year. If we know that we've had a big expansion, we took over another company or merged with another company, something like that. And so the common size financial statements are, again, really the vertical analysis, but only showing the percentages so that we can kind of focus in on what's important and not look at the relative size of the actual dollar amounts. And so our next exercise is going to be a common size statement. And let's go to that. Revenue and expense data for the current calendar year for Tannenhill Company and for the electronics industry are as follows. God bless you. Tannenhill's data are expressed in dollars. The electronics industry averages are expressed in percentages. And so we want to compare ourselves to that industry average. And thankfully, they copied the numbers down here for us. We don't have to scroll up and down copying. God bless you. And so to make it easier, they have included on this analysis still the dollar amounts for Tannenhill Company. In reality, those aren't needed. They're just going to make it easier for us, again, to have right there to do our calculations. Once we had those calculations, if this was, say, in a spreadsheet, we might want to just hide that column because the whole point of a common size financial statement is that it's not about the dollars, it's about the relative size of these various accounts. In this exercise, we are doing a common size statement for an income statement, but we could just as easily do this for a balance sheet. In our next exercise, we're going to do a vertical analysis of a balance sheet. And you can then imagine what that would look like if we just removed the dollar amounts and instead had only the percentages. And so we already know how to do a vertical analysis of an income statement. We set the sales being the largest amount. We set that to 100%. And then we express each subsequent line as a percent of that total. Remember, we can just add and subtract, so we don't have to redo calculations that are already there for us. It does tell us in this exercise to round your answers to the nearest whole percentage as well. So again, if we want to imagine hiding that column with the Tannenhill Company dollar amounts, because that's not relevant for our common size analysis. And so what do we notice? As a percent, Tannenhill's cost of goods sold is much lower than the industry average. But their total operating expenses are actually much higher, about 5% higher as a percent of their sales. And so those pieces together, when we look at those two pieces, the higher gross profit, but the higher operating expenses, is why Tannenhill's net income is 3% higher as a percent of sales, is 3% compared to the industry average of 1%. So they have a 2% higher profit margin than the industry average. And so if you are Tannenhill and you're looking at this, you're saying, that's fantastic. We're doing a great job with our cost of goods sold as a percent of sales, but we could probably do better with our total operating expenses. If you are outside of the company and trying to make a decision about would Tannenhill be a good investment, I'm looking to invest in a electronics industry company, would Tannenhill be a good investment? This is also going to be useful for that. They exceed the industry average for profit margin. Their net income as a percent of sales is 2% higher. It's actually 3 times as much as the industry average. So looking at part B, the company is managing the cost of manufacturing product better than the industry and has slightly higher selling and administrative expenses. I wouldn't call that slightly higher. It's 5% more of their sales taken up for operating expenses. That seems more than slightly higher. The combined impact causes net income as a percent of sales to be better than the industry average. And so again, the common size would not include that dollar amount. They've only put those in there to make it easier for us to do the calculations without having to scroll up and down. But you should be able to see from this demonstration how using the common size income statement might be helpful for some decision making both inside and outside the company. Any questions about that? All right, let's keep going then. Our next exercise is a vertical analysis of a balance sheet. So we already know that the vertical analysis for a balance sheet means that we set the largest number, which is total assets and total liabilities and equity for each year. We're going to set those to 100%. And then we're going to express each of the categories as a percent of that total. So we'll do the current year together. And they've made this really simple for us because everything's out of 10 million. So 2.8 million out of 10 million would be 28%. These percentages are really easy to calculate. Does tell us to round to 1 decimal place. Oops. And of course, if you didn't have the check my work button, you could check yourself by adding to make sure that all those percentages add up to the 100%. And so we can see that in the current year, current assets made up 28% of our total assets, property, plant, and equipment, excuse me, another 52%, and intangibles, the last 20%. Again, in the current year, our current liabilities make up 18%. Long-term liabilities are twice that at 36%. Common stock at 9.8% and retained earnings at 36.2% makes up the 100% of our credit side of the balance sheet. I'm going to pause the recording and ask you to do the previous year calculations on your own. Once you have those numbers, please restart the recording and we'll talk about what we see. Okay, so now that we have all of those percentages filled in and we calculated those based on just the 1 year, we're looking vertically, not horizontally. We have, we can then use this information. So what do we see from the previous to the current year? Current assets as a percent of our total went up by 8%. Where did that come from? Well, our property, plant, and equipment as a total, as a percent of our total assets went down by 14%. The increases then were seen in current assets and intangible assets. As we look down at the bottom portion, the current liabilities and also went up, but long-term liabilities went down. So it's knowing what we know about long-term liabilities. If you think about what you learned in chapter 11, what you covered for your project, as those current liabilities, as those long-term liabilities get closer to their due date, in that last year, they become a current liability. And so that's probably part of what happened there. That some of those long-term liabilities are closer to maturity, they become current liabilities. Our common stock went up. As by dollar amount, our common stock went up, but as a percent of the total, it actually went down. And retained earnings went up both as a dollar amount and as a percent. So we don't have an example of this in our exercises, but if we were asked to do a common size balance sheet, it would look just like what you see here, except the dollar amount columns would be hidden. And again, that would be helpful for us in maybe drawing some conclusions, whether we're inside or outside the company, to help us know what decisions we might want to make. If we're inside the company, maybe how we want to improve the processes or the running of our business. And if we're outside the company, we might be making decisions about whether to invest in the company or whether to lend them money, whether we might like to work for the company or something like that. Any questions at this point? Okay. Well, let's move on then to our next learning objective, which is analyzing liquidity. So some of the concepts that we're going to be looking at in exercise 5 and subsequent exercises, as I said at the beginning of class, are things that we've already talked about, but we've done them over the last several chapters, we've done them piecemeal. So in one exercise, we looked at one chapter, chapter 4, we looked at current ratio, but then in one of the liabilities chapters, we talked about the quick ratio. So if you are trying to make a decision about a company, again, internal or external, trying to make a decision about a company, you're probably not going to base any decision on just one single calculation. We want to get more of a big picture. And so to do that, we probably are going to be looking at a combination of different calculations. So when we talk about analyzing liquidity, we're looking not just at one single number, but it may be a whole series of numbers to see, how does all of this fit together to give us the picture of this company's actual ability to pay their bills, to stay liquid, to have enough cash to meet the needs or the objectives of the company. And so you can see on this list some of the actually, all of these calculations we have looked at in the appropriate chapter. So our next exercise, exercise 5, is going to be current position analysis. And you can see that that's going to include working capital, current ratio, and quick ratio. Each of those we covered in an earlier chapter, but we haven't looked at them all together. So that's going to be exercise 5. Exercise 6 is accounts receivable analysis. So we're going to be looking at accounts receivable turnover and days sales and receivable. Again, both of those we covered in the receivables chapter. And I will remind you in that exercise 6, of the easier way of calculating days sales and receivable, easier than what the textbook offers. And then in our next exercise after that, we'll be doing an inventory analysis in exercise 7. Again, looking at calculations that we already did in chapter 6 on inventories. So current position analysis in our next exercise evaluates a company's ability to pay its current liabilities. So we're going to be comparing something from the asset side of the balance sheet to something from the liability side of the balance sheet. Each one of these calculations includes the total of our current liabilities. That represents the amounts that we are already aware that we owe and will need to pay in the coming year. And so the current position analysis is telling us what's the likelihood that we will be able to meet those obligations again that we already know are coming. Because sometimes obligations might arise that we weren't planning, weren't expected, in kind of an emergency situation. So as we look at the current position analysis, we want to keep in mind that these are the liabilities that we already know, and we want to have a cushion or a safety net in case other situations arise that need our attention as an organization. Because we've already done all 3 of these calculations, I'm not going to go through the next slides where we show the formulas. I'll give them to you in case you don't recall. I will give them to you in the exercise. But we have, and actually, so if you hover your cursor over each one of those, it really does tell you, although it doesn't put it in math terms, it does tell you in words how to do each one of those calculations. The following data were taken from the balance sheet of Nylo Company at the end of 2 recent fiscal years. And so we can see the comparative balance sheet calculations, information that we need to be able to do these calculations. Working capital is the first, and working capital is expressed in dollars. It is the absolute difference, the excess dollars that we have in current assets that we do not need to pay for our known current liabilities. So the working capital for the current year is total current assets, 2.1 million, minus the total of our current liabilities, 1 million. And so we have $1,100,000 extra that we don't need to pay our current liabilities. And so that is our cushion, our safety net. That's the current assets that we have available to cover any unplanned business needs. How about in the previous year? Total current assets minus total current liabilities. In the previous year, we had just $540,000 in working capital. And so if the comparison that we're using is a horizontal or a trend analysis, doing side by side for the years, we would say their working capital has improved, has increased. If we only have that working capital number available though, because it's in absolute terms, because it tells us just what we have available in dollars, it doesn't really tell us how safe we are, because we don't, if we only know that number, we only know that number, that doesn't tell us whether it's big enough. You know, $540,000, if you're a small company, is probably a really nice cushion. But $540,000 if you're Apple is not going to get you through the next 5 hours. And so that's why we have the current ratio, which includes the same categories on the balance sheet. It uses the same dollar amounts, but rather than expressing the difference in dollars, we express it as a ratio. So 2,100,000 divided by 1 million gives us, for the current year, a current ratio of 2.1. Again, it's the current assets divided by current liabilities, 2.1. One way of interpreting that, for every dollar we have in current liabilities, we have $2.10 in current assets. We have an extra $1.10 for each dollar we have in current liabilities. And that gives us a better sense of the riskiness or security for this company. As I actually reminded you at the beginning of class today, one of the standards of comparison that we have is sometimes we have a rule of thumb. And we do have a rule of thumb for current ratio, which is 1.6 or higher, we're probably good. Now, that doesn't mean automatically the company's safe in terms of liquidity, but it's a good sign. We'd be pretty happy, likely, with a current ratio of 2.1. Go ahead, if you haven't already, and do the current ratio for the previous year. 1,440,000 divided by 900,000. And so the current ratio in the previous year was 1.6, which magically is the number I just told you is really our rule of thumb. So they were probably okay in the previous year in terms of liquidity, but this year they're even better. Their working capital increased. It actually doubled. Their working capital doubled from one year to the next, which seems like a good thing. But we needed to see the current ratio to see, yeah, but as a percent, how did it change? And so we went from having an extra 60 cents for every dollar in liabilities to having an extra $1.10 for every dollar in current liabilities, which seems pretty safe to me. The quick ratio, also known as the acid test, is another way of looking at how safe we are. And the quick ratio includes just financial assets as opposed to maybe physical assets or assets that we can't really use to pay our bills. And so, as I already mentioned, the denominator, the comparison that we're going to do is going to be to current liabilities. So rather than using all of our current assets, we're going to use in the calculation just the ones that can actually by themselves be used to pay our liabilities. And so we're going to exclude inventories. Why? Well, because we can't take our inventory and pay off our debt. Something else has to happen first. Probably we have to sell it. Well, the only way we can sell it more quickly than we otherwise would be to deeply discount it, to really cut the price and get you put on a fire sale, get people to buy it. And so, and we have $410,000 in inventories in the current year, but we wouldn't want to have to make a push to sell that inventory at a lower than desired price, just so we had that cash to pay our bills. And so the quick ratio, we're going to include, as I said, really just the financial assets, the ones that either are cash or could become cash with less effort on our part. So marketable securities represent stocks or bonds that are not a major investment in the company. And so marketable means we could sell them at their fair market value without having an impact on the market. And we could have that cash in relatively short order to pay our bills. Accounts and notes receivable, we didn't really talk about it much in class. I mentioned it, but when we talked about the receivables chapter, I mentioned the idea of factoring or securitizing receivables, that you can sell those receivables. Yes, you'd take a bit of a hit on the sale, but we could take most of those receivables and either collect from our customers fairly quickly or sell them off, bundle them, package them, and sell them for somewhat close to their actual value. So we'd have a little bit of a cost there, but not much. And so to do the calculation for the quick ratio for the current year, we're going to add the cash, marketable securities, and accounts and notes receivable. So we have $1.5 million in financial, or what we call quick assets, and then divide by the total current liabilities. And we have a quick ratio of 1.5. We also have a rule of thumb for the quick ratio, and generally we're looking for a quick ratio of at least 1.0, 1.0. That we have at least $1 in financial assets or quick assets for each dollar we have in current liabilities. And so it looks like this company's doing fine in the current year. But let's look at the previous year. Go ahead and do that calculation if you haven't already. And so in the previous year, they had only $1,080,000 in quick assets. Their current liabilities were also lower at just $900,000. So last year, their quick ratio was 1.2, again, higher than the 1.0 that we have as our general rule of thumb, but not quite as safe as we were in the current year. So our current position analysis for this company is they're improving on all fronts. The liquidity of Nilo has improved from the preceding year to the current year. Working capital, current ratio, and quick ratio have all increased. And why did these changes happen? Most of these changes are the result of an increase in current assets relative to current liabilities. So our cash went up, our marketable securities, accounts, inventories, and prepaid expenses, all of those increased. While our accounts payable increased, our accrued liabilities actually went down a little bit. Okay. Any questions about the current position analysis? Well, let's do one more exercise for today. And here, I'd like to get through one more exercise today. That'll put us a little bit more than halfway through the chapter, because on Thursday we need to have time to talk about the exam and the practice set as well. So our next exercise is accounts receivable analysis. Again, these are calculations that we have done in the receivables chapter. It was chapter 8. So this is not anything new, but it is putting it into play as we look at the entire concept of the company's liquidity. The current position analysis, accounts receivable, and then where we'll start on Thursday is inventory analysis. And all of these give us some sense of how the company is doing. The accounts receivable and inventory analysis, along with our payable analysis, those three pieces contribute to the calculation of our operating cycle as well as our financing period. And so we'll talk about that a little bit on Thursday as well. Accounts receivable analysis gives us a sense of how well the company is doing at collecting from their customers that they allow to buy on credit. There are two parts to this, as you know, and we know that these are inversely related to each other. So accounts receivable turnover tells us how many times on average the company is collecting from their customers within a year. So turnover refers to how many times per year, on average, the company is collecting all of their receivables. So accounts receivable turnover, higher is better. Higher represents or means that we are collecting more quickly from our customers. We can take that accounts receivable turnover number, which is expressed as a number of times. We can take that accounts receivable turnover then and turn it into how many days is it taking on average to collect from our customers? Or another way of looking at that is at any given time, how many days of receivables are sitting there uncollected? How many days of sales are sitting there uncollected? You can see at the top of the screen, and we're not going to go through this example because we're going to look at our own example in exercise 6, but you may want to make a note there of the calculation. Accounts receivable turnover is sales from the income statement divided by average accounts receivable. So average accounts receivable means we take the beginning and ending balance and add them together and then divide by 2. It's a straight or arithmetic average. It is not a weighted average. We do not have information about how the receivables changed throughout the year. As an external party analyzing the company's financial statements, the only information we have available is what the company is required to provide to us, which would include the beginning and the ending balance, but nothing about how it changed, went up and down throughout the year. So with that formula in mind for accounts receivable turnover, let's do the calculation for the first year. Accounts receivable turnover. The numerator is going to be, let me put the formula, the calculation here on the screen. So AR 8 turnover. The numerator is going to be their sales. Now, it is interesting that they point out to us in the top line in the given information, in terms of all sales are 210 net 45. You should know from chapter 5 how to understand or how to read those terms of sales, terms of sale. That means that they give all of their customers 45 days to pay, but they incentivize them to pay earlier by offering them a 2% discount if they pay within 10 days of the invoice date. So that's a review from chapter 5 on terms of sale. The 210 means they get a 2% discount if they pay within 10 days of the invoice date. The N45 means the net or the full amount of the invoice is due within 45 days if they choose not to pay within that 10-day discount window. So I said it's interesting that they give that to us. I'll talk about in a minute why that might be important. But you'll notice it tells you sales on account. But in reality, for a company, if we're outside the company, we don't know of their sales, which were on account and which were cash sales. So if we're an outsider, if we're someone external to the company trying to make a decision, rather than sales on account, we would have to use their total sales because that's all we would have available to us. Companies are not required to disclose what portion of their sales come from credit sales versus cash sales. The denominator then is going to be average accounts receivable. So I wanted to put this on the screen to remind you that you need to calculate the average. Make sure you have, if you're punching this into your calculator, make sure you have your grouping symbols correctly. Make sure that you add together the beginning and ending balance before you divide by 2. And if I just punch that correctly into my calculator, I got an accounts receivable turnover of 8.2. Anyone else get that same number? Anyone else get that same number? So the company's accounts receivable turnover in 2023 was 8.2. In other words, they're collecting on average, they're collecting from their customers in full the entire receivables 8.2 times per year. Accounts receivable turnover is expressed as a number of times that we collect in a given year. Now, the book gives you a little bit more complicated calculation for days sales and receivable. It's unnecessarily complicated. As I told you in the receivables chapter, the easiest way to calculate that is just take 365 days and divide by the accounts receivable turnover that we've already calculated. So don't make it any harder on yourself than you need to. We do need to round to 1 decimal place. So 365 divided by 8.2. On average, it's taking us 44.5 days to collect from our customers. Or another way of thinking about that is at any given time, on average, we have 44.5 days worth of sales that are sitting in our receivables uncollected. I told you I was going to come back to the terms of sale and tell you why that's important to know. As we're analyzing this company's receivables, it's important for us to know how long did we tell our customers that they could take to pay their bill. And given the terms of sale here, net 45, we told our customers they could take 45 days to pay. And on average, we now know they're taking about 44.5 days. So that's important for us to know. Are they paying on time? It looks like it, at least on average, they're paying on time. Based on this, I would suggest that maybe not a lot of them are taking the discount, the 2% discount for paying early. If they are, if we do have customers that are taking that discount, we must also have some customers who are taking too long to pay or slow paying to bring that average up to the 44.5. And so when we look at that 44.5, we know that our customers on average are paying on time. And that's a good thing for our liquidity. But we also have to recognize that when we make a sale, it's going to take us about a month and a half to get the cash from that. So we've already had to pay for the inventory, pay our employees and so on. But it's going to take us about a month and a half to get the cash. And so that extends our operating cycle and our financing period. If you have not already, go ahead and do the calculation for the previous year. And so for the previous year, sales of 4,687,500 divided by the average accounts receivable. The average of 650,000 and 600,000 is of course 625,000. So the sales divided by 625, I got an accounts receivable turnover of 7.5 times. Or translating that into days by dividing that into 365, our days sales and receivables 48.7. And so what we can say is that the collection of accounts receivable has improved. We went from taking about 48.7 days to only 44.5 days. We're now collecting from our customers on average, at least on time. This can be seen in both the increase in accounts receivable turnover and the decrease in the collection period. There's always going to be an inverse relationship. You know that because the second number is calculated by putting the first number in the denominator. Okay? Mathematically, it has to be that there's an inverse relationship between these two calculations. If one is going up, the other one is always going to be going down. From a liquidity standpoint, higher turnover, lower day sales uncollected is a better thing. We want to, from a liquidity standpoint, we want to be collecting from our customers as quickly as possible. I say that, but if that really is our goal to collect from our customers as quickly as possible, without any other considerations, we just wouldn't allow credit sales at all, right? If we want to collect from our customers as quickly as possible, we make them prepay or at least pay cash at the time of the sale. And then we don't have to have any of this conversation. So why do companies allow other customers to buy on credit? Because they know it's going to increase their sales. That on average, each sale is going to go up in dollars. Our sales will be higher for each sale, but also we'll have some customers buy from us that wouldn't buy from us if we didn't extend them credit terms. And so it's fine for us to say from a liquidity standpoint, we want to collect as quickly as possible, but there definitely is a balance here between maximizing our sales and maximizing our liquidity. And so that's why in this analysis, it was important for us to know that we tell our customers they could take 45 days to pay. And last year they were taking longer than that. Last year, the average customer was paying late. It was taking them more than 45 days to pay. And this year our results have improved. Okay, let me hit the check my work button, get our green check marks in there. And any questions about what we've done so far in the financial statement analysis. So you should be comfortable with vertical and horizontal analysis and the common size financial statements. We've now looked at the first two pieces of the liquidity analysis, and we'll pick up with inventory analysis on Thursday after we talk about the exam. So any questions, anything else you want to talk about before we call it a day? All right, well, thanks for all being here, and I'll hope to see you Thursday.